Hello everyone, good morning. My goal today is to give you a look into how a hedge fund manager operates and how it's set up, to discuss some of the tools and opportunities available to us and hopefully highlight to you why we believe hedge funds are the best investment for long-term wealth creation and also portfolio risk reduction. Many of you might not have heard of our business before, so I'm going to start by giving you an introduction to Peregrine Capital. I'll then move on to discuss the key features of hedge funds and how we differentiate ourselves from long-only asset managers, and then end with some interesting examples of the specific hedge fund opportunities we utilize, a few of which I hope would be interesting to you. So I was lucky enough to join Peregrine Capital in 2007 after spending 2 years working as an actuary. And very few people have the chance to get matched for really the perfect job for them at such an early stage of their careers. And I'm very thankful for the 13 years that I've spent with Peregrine Capital. Our business was started in 1998 with the aim of delivering industry-leading investment returns, which allows our clients to compound and grow their wealth at a greater risk-adjusted rate than they can anywhere else in South Africa. We are absolutely fanatical about delivering a product that is as good as we can possibly make it. We are resolutely focused on this goal and we work extremely hard every day to achieve it. We're a boutique asset manager managing around 6.5 billion rand of client money using a consistent approach over the 21 years that the business has been running. So let's move on to discuss why hedge funds are a good addition to a portfolio. For this section, we decided to compare our two major funds with the entire SA unit trust industry. Now remember, there's about 2,000 unit trusts in South Africa. We said, let's assume an investor had perfect foresight, and on the day that we created our funds, that he could pick the very best out of those 2,000 unit trusts over the following 20 years. How would that selection have compared to investing that same amount of money in our fund? Luckily, the outcome was quite favorable, so let's have a look at it. We can start with the graph on the right on the slide, looking at our pure hedge fund that's 21 years old. Since inception, the fund has returned about 5,700% versus the next best fund in South Africa that did about 2,150%. That means that 1 million rand invested in pure hedge on day one is worth 58 million rand now versus 23 million rand in the next best fund in the country. That's almost 3 times better. And interestingly, the next best fund in South Africa was not a low risk fund like Pure Hedge, so the fund actually took substantially less risk to deliver that excess return to clients. If we now move on to our high growth fund, high growth has done 8,600% for investors over the last 20 years, smashing the next best fund that's only done 1,450%. Again, 1 million rand invested 21 years ago in high growth is worth 87 million rand today versus about 15 million rand for the next best fund in the entire category of 2,000 unit trusts. That's more than 5 times our performance. And 85 million rand versus 15 million rand, it's almost 70 million rand better off the initial 1 million rand investment. This is something we're extremely proud of. And as you will understand, delivering this kind of excess return over 21 years can't just be done by having 1 or 2 good years. This can only be achieved by consistently outperforming competitors year in and year out and managing downside risk and managing drawdowns in the portfolio. So we are very pleased that we've been able to deliver that over a very long period of time. You might naturally ask, why haven't you heard about our funds before? Historically, hedge funds were not easily accessible to advisors or retail clients. Our client base was thus mostly made up of high net worth, private clients and direct investments from pension funds. This has changed during the last 2 years. It all started with the hedge fund regulations, where hedge funds are now part of the collective investment schemes regulatory regime, similar to normal long-only funds. The funds were always also monthly dealing only, and we have now launched 2 retail versions of our funds that allow daily trading, just like the unit trust industry. And additionally, we've also dropped our investment limit from 1 million rand to 25,000 rand, significantly increasing accessibility. Additionally, we have made our fund available. We have the goal of making our fund available on all major list platforms. We are currently already available on Momentum and the Allen Gray list, and we are working on the other two lists and expect to be listed on those shortly. Let's now talk through what a hedge fund is. A hedge fund is a regulated collective investment scheme, just like a unit trust. The hedge funds we run, the two retail funds, are daily traded funds and also available on platforms. Again, similar to unit trusts and other collective schemes you'll be used to. Hedge funds also have various risk profiles, similar to the long-only industry, with various risk and return outcomes. The easiest comparison to help you understand our funds is to compare them to the long-only multi-asset funds. Our high-growth mandate, which is our largest mandate, takes very similar risk to the multi-asset high equity mandates or the balanced fund category in South Africa, which again many of you will utilize. And our low risk fund, the pure hedge fund, is very similar to the stable fund category. However, the key differentiator is, as a hedge fund, we have more tools available to us to protect the funds in down markets, which is especially relevant in the current market environment. Let's now get on to why we as a business have chosen to run hedge funds and not long-only money. And I'll give you some of the key distinctions as part of this discussion. Firstly, our strategies are much more flexible with a wider variety of different investment strategies we can utilize to generate returns for our clients. Long-only asset managers are limited to buying and holding a share they like. If they don't like a business, the best thing they can do is to not own that business. As a hedge fund, we can also do that, but additionally, we've got the tool to bet against a company that we think will underperform the market. We can use shorting and put options to express this view. Again, during bear markets and tough times, long-onlys have many fewer tools available to them to protect the fund's downside and to reduce drawdowns. As I mentioned, put options, shorting, and reducing net exposure are all tools available to hedge funds that have very limited utilization in the long-only industry. Additionally, we are not benchmark cognizant investors. We don't care what the weightings of shares are in index. We can be purely focused on maximizing the risk-adjusted return for our clients. This frees us up from thinking just in terms of relative performance and helps us focus on what will be great investments. Taking all this together, hedge funds have the ability to generate positive returns regardless of the direction of the overall market. As we've seen with JSE over the last 5 years, it's exceptionally difficult for long-only funds to perform during bear markets or difficult markets for the JSE, where the additional tools that hedge funds have make them great investments all the way through the cycle. I now want to give you an idea of the risk-return profile you can expect from a hedge fund versus a similar long-only fund. This is a graph that you would have seen many times, graphing the return of a fund versus the risk it takes. As you expect for the industry as a whole, it's upward sloping, where over the last 15 years, stable funds gave you about 8% return, balanced funds 9.5%, and equity funds about 12%. I've then plotted our two major funds on this graph to give you an idea of the risk and return of them. So the pure hedge fund, as I mentioned, has a very similar risk profile to the stable funds, yet has generated about 5% excess return per annum over the last 15 years. The high growth fund takes the same amount of risk as the balanced fund, but has generated about 10% outperformance per annum over the last 15 years. So no more risk taken, but substantial excess returns. Again, it's an important point of the market cycle to look at how we manage risk and how the fund performs in tough times. So if I look at the pure hedge fund, over the 21 years it's been around, it's never had a single negative years. So it's a fantastic fund and product for clients that care about minimizing their downside risk. In fact, over that entire period of time where we saw a 40% pullback in markets on 2 occasions, the pure hedge fund has had a maximum drawdown of only 5%. For high growth, again, the outcome has been much better than the market. While we have had 18 positive years out of 20, our maximum drawdown has again been substantially less than the market, at about 17% versus 40% for the all-share index. Both funds have also consistently more positive months, helping clients invest comfortably. Another slide to look at how we perform in down markets is to compare the performance of our high growth fund with that of the market in the negative years the market has had. To say, how can you expect this fund to behave when there's a real big fall in the market like we've seen in 2020 and also on several earlier occasions? As you can see on this graph, during the 2000 and 2002 sell-offs, the fund actually was substantially up during those years versus the down market. And even in 2008 and 2018, when the JSE had very negative years, the high growth fund was down substantially less, giving a significantly more smooth ride to investors during that time. Another way of comparing our funds with competing long-only products is the standard risk versus volatility scatter plot. So we've taken the largest 3 balanced funds, which are inevitably the 3 most popular funds in South Africa, and compared their risk return with that of the high growth fund. As you can see, high growth has almost exactly the same volatility as the major 3 balanced funds, yet has generated about a 10% excess return and outperformance over the past 10 years. And it's significantly lower risk in the market, again delivering about 10% more. If you look at Pure Hedge, the picture is as good. Pure Hedge has actually taken much lower risk than the 3 largest stable funds in South Africa and has still managed to deliver 5% better returns every year on average for the last 10 years, even outperforming the market at much, much lower risk. So let's look at the correlation of our funds with the market and with competing funds to see how it will fit in to your overall portfolio. On this graph, we've looked at the 5 largest unit trusts, and that's the most popular ones in the SA market, and their correlation with the overall market. As you can see, the correlation is actually extremely high, and all of them have an 85 to 95% correlation with the market, which means your portfolio, if you're just invested in the popular funds, are going to be very, very linked to how the overall markets do. If you look at high growth and Pure Hedge, that correlation is much, much lower. So you can often have a scenario where there's a down month and these funds will outperform or deliver positive return. High growth only has a 65% correlation, and Pure Hedge has a fantastic outcome with only a 35% correlation to the overall JSE All Share Index. Let's now move on to look at some of the tools and opportunities we have to make money in these kind of difficult down markets. Firstly, I'll discuss a shorting example. Let's look at a business like Nampak that produces a lot of packaging material and beverage cans in South Africa and in Africa. We identified a few years ago that this business had too much exposure to Africa. They had rushed into African acquisitions and made a few bad deals, and it was clear that they would struggle to get access to US dollars, and also that the demand for packaging products in those countries were highly uncertain. We thus shorted the share at about 20 Rand a share with a view that the business was worth substantially less. As it ended up playing out, the business has significantly underperformed the overall market. They had issues with dollar availability as we thought. The Zimbabwean business got into very big difficulty, and there was also increased competition in the South African markets with competitors entering. We just sold short the company at 20 Rand a share and bought back our short at 6 Rand a share, making a 70% return. Again, this is a return that no long only can make. The best they can do is not own Nampak and not lose any money on the share, where we can actually generate returns. Another interesting example is African Bank. Again, a share that many unit trusts lost money on owning African Bank, where the share eventually went pretty much to zero as the company entered curatorship. We did not have a position in African Bank, and I guess what we did is we did a lot of work on the company going into the failure, through the curatorship, and coming out of it. A fantastic opportunity we identified in this was buying the instruments that was left in the bad bank. So when African Bank came out of curatorship, they split the business into a good bank with the performing loans and a bad bank with the old underperforming loan book. We identified the bonds that was left in these bad bank as very underpriced, as many clients on the bad book were still repaying a portion of their loans. We thus built and established a significant position in these bonds, and we've made a 900% return over about 3 or 4 years owning those. I guess the exciting thing about this instrument is this is not something you might have even heard of for a long-only fund. They often can't access these instruments, yet we can find something that's uncorrelated to the overall market that significantly enhances client returns. Let's now look at probably the most relevant example in the current market conditions. As a fund, we actively use put options to protect the fund from periods of market downside. A put option is protection you buy on an overall index that pays off and provides return to the fund during periods of market downside. During February this year, we became very concerned about the impact the coronavirus would have on the global economy. This was during a period when many world leaders and most market participants were way too calm about the effect this virus would have, and were not preparing both their countries and their portfolios for this impact. So we were able to buy put options on the S&P index at very low volatility, and while the markets were still at its absolute peak, to protect a large part of our funds from the downside of any potential impact from the virus. As this downside played out then during the end of February and March, this provided a significant return to the funds, which absorbed a lot of the downside we saw in our positions, and also put us on the front foot and allowed us to actively buy fresh exposures in the fund at very attractive levels during that sell-off. So again, being a hedge fund, being flexible and being able to utilize this in significant size allowed us to protect the downside for our investors and ensure that the fund was well positioned for a turnaround in markets when that would inevitably come. So just to end off, let's again look at our funds and how they compared with competing funds as well as with the overall market. Our high growth fund invests in our very best ideas and has delivered industry leading results. On this graph you can see the 3, 5, 10, 15 years and since inception performance. And what's very pleasing to us is that over every single one of these time horizons, our fund has significantly outperformed both the peer group funds and the overall markets by between 5 and 15% per annum, depending on the time period you look at. The picture looks fairly consistent and similar for the pure hedge fund. This fund is much more about stability, giving clients certainty in outcomes with the aim of delivering around 10% per annum returns with very low drawdowns, low downside, and consistently beating both cash and competing funds. As you can see, over all time periods, 3, 5, 10, 15, and since inception, we've significantly outperformed both the peer group being a multi-asset low equity category and the overall markets. Just to touch on it again, this fund has never had a negative year in its 21 years. So it's a very smooth ride for our clients. Thank you very much for the interest you've shown in our funds. If you're interested in considering an addition of our funds to your portfolio and want to discuss that with us, please reach out. I've put the contact details of both Alan Yates and Dudley Lamont Smith on the slide. They are two staff members dealing with new client onboarding and investor queries. Please email or phone them if you want more details, if you have any questions, or if you would be interested in becoming a partner and investing with us. Thank you very much.